Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. Today, we're going to be answering all of your questions about the latest stock market moves with CNBC's senior stocks correspondent, Bob Pisani. Nice to see you, Bob. Hope you had a happy
Katie,
New Year.
Happy New Year. You too.
Yeah. How are things going so far for you in 2022?
Everything is fine. We're all navigating through Omicron. Everybody's trying to stay safe and healthy. The markets are holding up, and you know me. I'm a glass half full guy. We're going to get through this, and the markets are telling us that the economy is holding up very, very well right now. So I think this time next year we'll all be getting a flu shot combined with a new COVID shot, whatever the new variant is, and we'll learn to move on.
Yeah, exactly. So let's jump in right there. We're wrapping up the first week of trading of 2022. Where does the market stand after this first week?
Well, the big story for 2020, the big story for 2021 was navigating the virus, and to a certain extent, that's still what we're dealing with. But there's another overlay now. The big story for 2022 is the withdrawal stimulus. The Federal Reserve and the federal government have been pumping a lot of money since COVID into the economy, but really going back to 2009, the Federal Reserve has been pumping money into the economy just to deal with the aftermath of the great financial crisis. So there's a lot of money sloshing around, and they're slowly withdrawing that. And if you believe that somehow that helped juice the stock market a little bit by whatever amount, withdrawing it would logically think to be a bit of a headwind. So I think the big story for 2022 so far is stimulus withdrawal and inflation concerns. And anything that changes that narrative is going to affect the market. So look today at this jobs report. It's kind of confusing to figure out. There wasn't as much job creation as expected, but we have a separate report where they do an employment check, and the unemployment rate went down 3.9%. And that's really low. I mean, so it appears as if jobs are, a lot of people are still quite employed, and the economy is holding up very well. I think the problem is with these jobs reports is that they can't quite capture how dynamic the U.S. economy is. I think a lot of people are self-employed these days. That's very hard to capture in these reports. So I think what the market's going with here, if you look today, what we're seeing here is there's some concerns about wage growth, which I think is a good thing, but there's concerns about inflation there. And that's weighing on the markets a bit. But overall, so far, the narrative on the economy is Omicron is slowing, but it's not derailing the recovery. And you could see this in things like energy stocks. Oil's at $80 today. That's back where it was before Omicron in November. Oil is a proxy for global growth. We're hitting ExxonMobil is at a new high today. I mean, when was the last time? I mean, that's a while since that's happened, I can assure you. So not only energy stocks, but industrials and materials, stuff we call cyclicals that do better when the economy's doing better, have been doing better this week. Energy's on a tear. Banks are doing really well. We've got new highs in Bank of America and a lot of these regional banks. So I think what we're seeing here is the markets come to believe that earnings are still going to be strong. Margins, profit margins are still going to be strong. Some companies are under some pressure on costs because the costs are going up, but most companies have pricing power. They're able to raise prices, and that is what's holding up the stock market right now.
So you mentioned inflation, and we'll definitely jump into that in a little bit. But first, I wanted to get your perspective on how should investors position themselves for rate hikes this year?
Well, my sense is, I'm a market historian. I've studied how the markets acted. And I think people should sort of moderate their expectations. We've had extraordinary gains in the stock market. The last 3 years are crazy. I mean, I think we were 27% up in the S&P 500 last year. But since the great financial crisis, since 2009, the S&P 500 is up an average of 15% a year. Is that a little, a lot? Oh, that's a lot. The average gain in the S&P 500 for the last almost 100 years has been a price gain, 8-9%, somewhere around there. That's the average. If you throw in a 2% dividend, it's 10% or 11. But 8 or 9 versus 15%, that's extraordinary for 13 years. What's way above the normal returns for the last 13 years. So there's this thing that happens in most financial systems called mean reversion, where things tends to go back to the long-term averages. And I can't help but think that, with the Fed raising rates, that's a little bit of a headwind for the overall economy. Not a lot, if it's, but I would be moderating your expectations for stocks. And bonds are the same thing. We've had record low rates for, it's been trending down for 20 years. Do you think you're going to get a 2.5% mortgage rate forever? I don't think so. It's already up to 3.25%. I think it's reasonable to expect interest rate levels and bond yields to go up a little bit. I don't expect it to go up a lot, but if the 10-year goes from 1.5% to, and it's 3% this time next year, I wouldn't be surprised. People ask me about real estate. I don't know. Have you seen real estate, residential home prices? They've been crazy the last year. Crazy. That's not going to continue. Real estate has mean reversion too. You're not going to have 15, 20% increases in real estate, residential real estate prices. Commercial real estate's got a little more pressure because of COVID. That's still playing out, but I would moderate if you're expecting, your home to appreciate 15 or 20% this year. I would moderate that expectation. That is highly unlikely unless you're in a very unusual area. So I guess my point here is, given how great the returns have been in the last few years, I would moderate your expectations and not expect these kinds of returns in 2022. I still think the stock market can be up this year because the economy is strong, but 27% like it was last year, I wouldn't bet on that one.
Yeah, so just to continue with this theme about looking out for the year ahead, what does inflation mean for the market in 2022?
Well, the thing about the stock market is it's a very good discounting mechanism for inflation, because when you get moderate inflation, corporations have pricing power. What does that mean? It means that by and large, they can raise prices. Now, that doesn't mean everybody can. A lot of people will push back. So, a Hershey bar is $1, and suddenly 1 year it's $1.05. The market could probably handle that, providing there's enough supply, and there's not a really cheap alternative. But if it goes from $1 to $1.30, you're going to get. So what's been happening is, because people are flush with cash and stimulus money, corporate America has been able to raise prices and to account partly for the higher costs that they're seeing, but also to improve their profit margins. And there's not a lot of pushback. Eventually there will be, but there'll be natural forces that will push back against that. The market is betting that these supply chain disruptions we saw last year are going to abate in the first half of the year. Now, so far, they're still with us, but there are signs, the chip shortage is abating a little bit. The automobile shortage may be abating a little bit. So, that could change, but I would just say, in terms of inflation, the stock market, when there is moderate inflation, what's moderate? 2, 3, 4%, does well because companies have pricing power. Where it doesn't do well is when all of a sudden you get enormous inflation. This is what happened in the early 1970s, when we were getting double-digit inflation in some years. And the market really had a problem with that, because what happens is corporate America can't raise prices as fast. I just used the Hershey bar. If you go from $1 to $1.05, that's one thing. But if you go from $1 to $1.30, people are going to push back. They're not going to do it. They're not going to buy the Hershey bar, or they're going to find some cheaper alternative. I don't anticipate that kind of inflation, but there are some parts of the economy that are seeing more inflation now than they've seen in many years. So again, stocks, moderate inflation, fine. If it gets a little out of hand, that's going to be a problem for the stock market. That's not my base case.
So let's dive into one big tech stock in particular, Apple. Apple just hit a market cap of $3 trillion. Is there a tech bubble?
Well, no, and I'll tell you why. The whole Delta variant, Omicron, COVID thing highlighted the value of technology. Look where I'm sitting here in my house. We all moved in all of a sudden, and we're using technology behind. You see the camera behind me, but miniaturization and software has changed the world, and it only got more important during COVID. So there might be, in some sectors, some stocks, valuation bubbles. Now, if you're asking me about Apple, Apple is trading right now for about 30 times forward earnings. This is the PE ratio. You should pay attention to these multiples, because the multiple tells you how much are you as an investor willing to pay for a future stream of earnings. And right now, the market is paying 30 times 2022 Apple's earnings estimates for the stock. Now, historically, that's a bit on the high side. Prior to COVID, Apple was 20 times forward earnings, forward meaning the forward year, the year in front of us. Maybe got up to 22 or 23, somewhere around there. But so this is just historically on the high side, but COVID has changed everything. And it's made people even more reliant on technology. So Apple's revenue prospects are tremendous. So if you're a traditional Apple bull, you can argue it's a little on the pricey side. But given the growth potential, most people would say it's not stupidly overvalued. Now, where you have problems is with some of, we call them speculative stocks, tech stocks. That's a kind of a bad term, but these are the Cathie Wood stocks, Cathie Wood at ARK, Shopify, Square, Zillow, Twilio, DoorDash. The problem is a lot of this stuff either doesn't make money, Twilio doesn't make money right now, or the profit margins are razor thin, meaning they're not making much money. The stock price is really high, and the amount of money, the profit is really small. So the amount of money, the PE ratio in some of these are 100, or 200. That's very expensive. And when interest rates go up, it makes these stocks less attractive because it reduces the potential future stream of earnings revenues that are out there. So remember, the bond market competes with the stock market. You might not think that, but it does historically. Rates have been so low so long that most people don't think about it, but it does. So if you could buy a risk-free investment, 1.5%, a 10-year bond, 10-year treasury bond will pay you 1.5% a year, and at the end of 10 years, you get your money back. That's risk-free. The U.S. government's not going under. You can't say that with Apple. You can't say, I'm going to get 1.5% in Apple for the next 10 years. You can make the assumption that you will because Apple has tended to go up, but it's still a risk. Now, suppose the 10-year treasury yield goes from 1.5% to 3%. Well, that's a big move. And we could very well be there this time next year. I think that's quite possible. Well, 3% is a little more interesting. You might now say, well, what do I need to get from Apple to be compensated to own Apple for the higher risk? I could get 3% risk-free. Why wouldn't I just put a lot more money in the 10-year treasury? Well, because I'm going to take a risk on Apple because Apple's returned more than 3% historically. Okay, but it's not a guarantee. My point is, as interest rates go up, the higher priced names get a little bit more speculative, and you have to be compensated for owning them. This is, the whole basis on which Wall Street is based. And when you have companies, not Apple, but the Shopifys, the Squares, the Zillows, the Twilios, DoorDash, those kinds of companies that really don't make much money or don't make money at all, that becomes a lot more problematic. And if you look, it's those companies that are getting hit 8, 9, 10% down this week. It's not Apple, because Apple is hugely profitable, has a constant stream of cash flow. It's pretty good. It's a subscription-based model. So that stock wouldn't be getting hit as much as more speculative stuff that's out there. So this is where rising interest rates matter. When you're dealing with really high-priced speculative stocks, they become less attractive in a higher interest rate environment. That's the simplest way I can say it. And the problem with Cathie Wood is not that she failed. The problem is she succeeded. I think she's tremendous. I'm a big Cathie Wood fan. Here's the problem. She's right about the power of disruptive technology. She convinced everybody, and they all bought into this. So they drove the prices through the roof for these stocks. They were too high priced. And when you have a change in the environment, when interest rates go up and the Fed's withdrawing liquidity, people look at other possibilities and they say, well, really, am I going to worth paying 100 times forward earnings for this company? Maybe it's too high priced. So there's a reckoning. There's a re-rating of some of these stocks. And that's not surprising. It's not because Cathie Wood failed. It's just because people drove the prices up too much. That's what the stock market does. It's a discounting mechanism for figuring out stuff in the future.
Yeah, and it's interesting, like you were saying, with technology, just how much more reliant we are in the past 2 years. Who knows where we're going to be 2 years out from now? How much more reliant? Yeah, a lot more, yeah. I'm sure. So you mentioned Cathie Wood. I know a lot of investors are obviously very interested in what she has to say. Another area that people are very interested in is crypto. What are your thoughts on crypto in 2022?
Well, I think that blockchain is one of the most important technological advances of the last 50 years. I think it may be the most important thing that's happened since the internet. And we're in the very early stages of this. I think this is like, I don't know what year it would be, it's like the internet, potentially. There's just a huge array of opportunities out there. I have been neutral on Bitcoin. Bitcoin is a cryptocurrency running off the blockchain. Bullish on blockchain, neutral on Bitcoin. Why am I neutral on Bitcoin and all coins? Well, the problem we have here is you can't figure out what the value of these things are. So in the stock market, where I have been for 32 years at CNBC, at 25 as the stocks correspondent, is this, stocks have what are called intrinsic value. Fundamental analysis is about trying to figure out the intrinsic value. What's the present value of a future stream of earnings and dividends? And you can make a guess about whether this current stock is overpriced or underpriced based on what their dividend's going to be and what kind of earnings they're going to throw off in the next pick a year, 1 year, 2 year, 3 years. It depends on what your analysis is. That's called fundamental analysis. You can't do this with crypto. You can't. It doesn't have any intrinsic value. It's like, this is the same problem with gold. What does gold do? It just sits there. It doesn't throw off a dividend. It doesn't throw off a future stream of earnings, and neither do collectibles. I keep pointing, these rock posters behind me. I've been collecting these rock posters for 30 years. They don't have any intrinsic value. They don't pay any dividend. They just sit there and take up space. So here's the problem. This is true with Bitcoin and true with crypto. They don't have a intrinsic value. So do they have any value at all? Well, no, they don't have a value, but they have a price. This is why people ask me, is Bitcoin worth $50,000? It doesn't have a value. It's worth what anyone will pay for at that moment. So valuing this stuff becomes very difficult. You have to be comfortable with that fact. It's not unique, okay? Remember, this is a problem with gold too. Gold is a store of value, but does it have a intrinsic value? No, it just sits there. Think about it. So you have to be comfortable with that. But I believe that blockchain has, and particularly decentralized finance, has tremendous opportunity to reduce financial friction in the market, to be able to send money anywhere you want in the world without having to pay a 3% VIG to JP Morgan that controls the global traffic in bank payments or bank remittances, or to use blockchain to settle real estate transactions, or to even settle stock market transactions. It just is an excellent opportunity to reduce friction in the financial system, and that's what you want to do. You want to reduce friction in the financial system. This is why I'm a big backer of blockchain. But don't try to paint me as some fanatic on Bitcoin, because I'm not. I'll tell you what I would like to see. I want to see a US dollar tethered to blockchain. That's more reliable. That, I think, would go a long way for dealing with the need for a cryptocurrency. I don't particularly believe in any particular value on Bitcoin at all, or any other ones. They may be useful, but don't ask me to value them. I want to see a dollar that's easily to move around. And I think that will go a long way towards satisfying a lot of the need that people have for cryptocurrencies and the blockchain. So I think it's going to be a good year. On Bitcoin ETFs, which is what everybody asks me about, forget about it. I just don't see it happening. I don't see the SEC comfortable with ownership unless of Bitcoin itself, unless they get clear regulatory control over things like the exchanges and a clearer definition of what is and what is not a security. I think there's going to need to be congressional action to do that. I think we need a crypto bill. But I don't see that happening in 2022. So I'm afraid we're going to do punting on the pure play Bitcoin ETF 2022. That's my guess.
So our last question is one that actually came up a lot, and maybe it's because it's a new year and people are looking to get investing for the first time. But what advice would you give to someone who's looking to invest for the first time?
Stay long and invest on a regular basis. The one thing that we have known for decades is generally market timing does not work. Don't think, oh, is now a good time to put money in the market? If you're 25 years old or 30 years old, you're going to live 60 more years. It is a silly question to ask. I'm 25. Oh, maybe the market will go down this year. Dude, you're going to live. Don't worry about it. The market goes up 3 out of 4 years. You're not even going to be thinking about this 10 years from now. The key is to invest early. The biggest mistake our generation made, I'm a baby boomer, was we didn't save money early enough. We spent all the 1970s partying and having a good time and traveling. I went all over the world in the 70s. Man, it was a hell of a lot of fun, I think. But we didn't save any money. So all of a sudden we get into our mid-30s and we don't have any money. We don't have any money saved. We all had to scramble and, pay attention more. Don't do that. Don't make the mistake the baby boomers made. This is why the baby boomers need more money in their retirement accounts, because they didn't do it earlier. So start. And you want to see, look, talk to any financial advisor. Keep costs low. Don't let them charge a lot of money for you. The simplest thing to own, ask any financial advisor, is the S&P 500. SPY if you want, or IVV. There's a number of these ETFs that track the S&P 500. VOO, which is a Vanguard one. They charge 3 basis points a year. That's $3 for a $10,000 investment. Think how cheap that is. And you can own essentially 80% of the stock market in a single stock. You could sit on that for the rest of your life, and you wouldn't be an idiot. You would not. You think you want to pick stocks? Go ahead. Most financial advisors will tell you, and this is Jack Bogle used to say this, the founder of Vanguard, the guy who had the single biggest influence on me my whole life, used to say, okay, if you got this itch, you think you're a genius to pick stocks, take 10% of your money and go ahead. Pick a few things, but don't pick much. Pick a couple things. You want to buy Apple for a year? Go ahead. What you're going to probably find is you're not a genius. Over time, there will be mean reversion. It is almost impossible to beat the market over long periods of time. It's a fact. And think about it. The market is a zero-sum game. If you make 3% on your investments in a year, and you think you're a genius, somebody has lost 3% because you can't outperform, everybody can't outperform the market. Everybody is the market. So, if the S&P went up 5% in a year, and you went up 7%, you outperformed, somebody underperformed somewhere, okay? And if you add in the cost of doing that, what they charge you to own these, the whatever 1%, long term, that's another drag on performance. You're going to underperform because of that. So the key to the game is stay with the market and keep your costs as low as possible. That's why I'm a big backer of ETFs. That's why I'm a big backer of index funds. If you think you're a genius and you want to scratch that itch, go ahead, take 10% and play around. But you're going to find, and we may be in for some rocky markets, it's going to be very difficult for you to time the market and time investments because you have to be right going in and you've got to be right going out. And mathematically, that's very, very difficult for anyone to do long term. If you don't believe me, go look at the S&P 500 SPIVA report. Twice a year, they evaluate fund managers. They have been doing this for decades at the Dow Jones indices. Over a 10-year period, 85% of all fund managers underperform their benchmark. 85% of all fund managers. The probability you're picking a fund manager that's going to outperform is stupidly small. That's why I talk about index funds and ETFs. Low cost, staying with the market. That would be any financial advisor worth his salt advice. And if they tell you a lot differently, I would look very carefully at the fine print, because the historical evidence is very overwhelming. So look up a good financial advisor and see where they're advising most people, and you'll see there is money pouring into ETFs. Most of it is indexed, meaning tied to an index like the S&P 500. The reason that's happening is more and more people are aware of the fact that it's very difficult to beat the market. You want to be a long-term investor. Any financial advisor will tell you that you want to be a long-term investor and you want to keep costs as low as possible. Sorry to go on like this, but I feel very strongly. And investors, financial advisors that are coming on CNBC are largely saying the same thing. And by the way, we have some very good active managers come on our air, and their job is to pick stocks. It's very tough, but we've got some very good ones.
Yeah, that's great advice, Bob. So if you're looking to start investing, definitely listen to Bob. He's been doing this for a long time. He's seen the market go up and down many times. So great advice. Thank you.
Thank you, Katie. And everybody have a healthy, happy new year. And I love talking to everybody. These are always great questions. You guys are always asking the right questions. This is what I have to deal with every day. And it never fails to amaze me. You ask exactly the questions that I'm dealing with every day.
Yeah, great questions, everyone. So thanks, Bob. And we'll